Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Want to win in the stock market? In this episode, we reveal 5 rules for successful stock investing: smart, simple, and proven. Let's get into it.
All right, so ready to dive into the world of stock investing? Today we're going to break down some key insights from 5 rules for successful stock investing. Hopefully, by the end, you'll be able to avoid those common pitfalls and really start building a solid investment strategy.
Sounds like a plan. And a great place to start is with the most fundamental rule. Rule number 1, do your homework. It's so tempting to just jump right into the market, but that can be a recipe for, well, disaster.
Yeah, I can imagine. Kind of like trying to bake a cake without a recipe, right? You might get lucky, but more likely you'll just end up with a mess.
Exactly. You really got to understand the businesses you're investing in. Before you even think about buying a stock, ask yourself, can I actually explain what this company does and how it makes money?
Makes sense. But okay, how do we actually do our homework? Where do we even start?
Well, the financials are a good place to start. Look at things like income statements, balance sheets, cash flow statements. I know those might sound a little intimidating.
Yeah, a little.
But they're really just tools. Tools to help you understand how a company is performing financially.
So like a financial checkup for a company.
Yeah, exactly. You're basically checking the vital signs, looking at things like revenue growth, profit margins, debt levels. All those things kind of give you a sense of whether the company is on solid ground.
So it's not enough to just know what a company does. You got to know how well it's actually doing.
Right. And one of the key metrics to look at here is return on equity, ROE. It basically tells you how effectively a company is using its money to make a profit. So let's say you've got 2 companies, both with, say, $1 million in assets. Company A makes $100,000 in profit. Company B makes $200,000. Company B would have a higher ROE because it's generating more profit with the same amount of assets.
Okay, starting to see how this all fits together. But what about the bigger picture? Do we need to look at the industry a company is in or its competition?
Absolutely. Got to look beyond just the numbers and think about that competitive landscape. What are the barriers to entry in their industry? Do they have any unique advantages, like a strong brand or, some proprietary technology?
This is where people talk about economic moats, right?
Yeah, exactly. A moat is basically that sustainable competitive advantage that protects a company from its rivals. Think of it like a castle surrounded by a moat. The deeper the moat, the harder it is for competitors to attack. So a company with a wide moat that's more likely to maintain its profitability over the long term.
Got it. So like Apple, for example, with like that crazy strong brand loyalty and their whole ecosystem of products.
Perfect example. It makes it really difficult for other phone manufacturers to even compete.
So doing our homework means looking for companies with strong financials and strong moats. Makes a lot of sense. It feels like we're already building a checklist for smart investing.
And that checklist leads us perfectly to rule number 2. Think long term. It's so easy to get caught up in those day-to-day market fluctuations, but successful investing is all about the long game.
Right. I've heard that saying, time in the market beats timing the market. But what does that actually mean?
Well, it means that trying to predict those short-term market movements is really tough, even for the pros. It's kind of like trying to guess if a coin's going to land on heads or tails.
So instead of trying to outsmart the market, we should just be patient, let our investments grow over time.
Exactly. Historically, the stock market has always trended upwards. Over the long term, I mean. Of course, there will be, dips and crashes along the way. But if you stay invested, you kind of ride out those fluctuations, you're much more likely to come out ahead in the end.
Thinking back to that coin toss, it's like if you flip it 100 times, you might get, a few tails in a row. But over time, it'll even out to roughly 50-50.
Great way to think about it. The longer you're invested, the more likely you are to actually benefit from those long-term upward trends.
Okay, so we're starting to build a pretty solid foundation here, right? Research your investments, understand the financials, look for those strong moats, and then be patient and let your investments grow over time. What else? What comes next?
Well, even with, the best research, there's always going to be some risk involved
Right.
in investing, And that brings us to rule number 3, all about managing that risk. Diversify wisely.
Okay, yeah. Don't put all your eggs in one basket. Heard that one before. But what are like some common mistakes people make when it comes to diversification?
One of the biggest is, well, not diversifying enough. Some people get really concentrated in just a few stocks or even a single stock. And if that stock takes a hit, their whole portfolio suffers. But then on the other hand, you get people going overboard, ending up with a portfolio that's too diversified.
So there's a sweet spot. How do we find it?
It depends on your, individual risk tolerance and investment goals.
Yeah.
But a good rule of thumb is to invest across different sectors of the economy. So don't put all your money in, say, just technology companies. Spread it out. Look at things like healthcare, consumer goods, energy, and so on.
So even if one sector is kind of struggling, the others can help balance things out.
Exactly. And diversification isn't just about sectors. It's also about asset classes. Stocks are just one asset class. You might also consider, bonds, real estate, commodities.
So building a diverse portfolio is kind of like assembling a team of all-star players, each with their own skills and strengths.
Huh, I like that analogy.
Yeah.
You want a team that's well-rounded, that can perform well under different conditions.
This is all starting to make a lot more sense. We've covered doing our homework, thinking long-term, diversifying wisely. What's next? What's the next rule in our smart investing playbook?
Rule number 4 is about being proactive. Manage risk proactively. Even with a diversified portfolio, you got to be aware of the risks involved and take steps to, well, mitigate them.
So it's not just set it and forget it. We need to be actively involved in managing our investments.
Absolutely. One of the most important aspects of risk management is setting clear goals. Investment goals, I mean.
Mm-hmm.
What are you hoping to achieve with your investments? Are you saving for retirement, a down payment, maybe your kid's education?
Makes sense. If you don't know where you're going, how do you know how to get there?
Right, exactly. Once you know your goals, you can, start to develop a strategy that aligns with them. You also need to define your risk tolerance. How much volatility are you comfortable with? Are you okay with more risk for the potential of higher returns, or do you prefer a more conservative approach?
And knowing our risk tolerance helps us make, smarter decisions, even when the market gets a little crazy.
For sure. For example, if you know you have a low risk tolerance, well, maybe avoid investing in more volatile sectors, like emerging markets or speculative growth stocks.
Okay, that makes sense. So how does over-leveraging fit into all this?
So over-leveraging. It's essentially when you borrow money to invest. It can amplify your gains, yeah, but it can also magnify your losses. It's important to use leverage very carefully. Make sure you really understand the risks involved.
Sounds like it can turn like a small bump in the road into a major crash.
Yeah, good way to put it. It's important to remember that investing always involves some risk. There's no way to eliminate it entirely, but by managing it proactively, you can protect yourself from those, major crashes and make better decisions. Stay informed about market news, economic trends. Don't be afraid to adjust your strategy as needed.
Wow, it feels like we've covered so much ground already. We've talked about research, about thinking long-term, diversification, managing risk. Is there anything else we need to keep in mind, as we start this investing journey?
Well, all those things are super important, but they won't do much good if you don't have, the right mindset.
Mm-hmm.
And that brings us to our final rule. Stay disciplined and consistent.
So it's not enough to just, have a plan. We actually have to, S2 the plan.
Exactly. It's easy to get emotional about investing, right? When the market's up, we get greedy, we want to buy more. But then when the market's down, then we get scared. We want to sell.
I've definitely been there.
And it's those emotional reactions that can lead to some really bad decisions.
Yeah, for sure. So how do we, avoid those emotional traps? Stay disciplined?
Well, one way is to develop a more, systematic approach.
Yeah.
You might consider a strategy called dollar cost averaging. It basically means you invest a fixed amount of money at regular intervals, no matter what the market's doing.
So instead of trying to, perfectly time the market, we're just consistently investing over time.
Right. So when the market's down, you're buying more shares at a lower price. And then when it's up, you're buying fewer shares at a higher price.
Uh-huh.
Over time, this helps to even out your average cost.
That makes sense. Consistency seems to be a big theme here.
It is. And another key part of that is reinvesting those dividends. When companies pay dividends, you have the choice, right? Take the cash or reinvest it back into the company. Buy more shares. Reinvesting lets you take advantage of compounding.
Compounding, yeah, I've heard of that.
It's this amazing idea. Your money makes money. And then that money makes more money. It's like a snowball rolling downhill.
Yeah.
It gets bigger and bigger as it goes.
So the longer you're invested and you're reinvesting those dividends, the more that snowball effect kind of works for you.
Exactly. Compounding is one of the most powerful forces in investing. And it really shows why staying disciplined and staying consistent over the long term is so important.
So to recap, we've got 5 essential rules for successful stock investing. Do your homework. Think long-term. Diversify wisely. Manage risk proactively. And stay disciplined and consistent. These rules give us, a solid framework for anyone who wants to build a strong portfolio.
And it's important to remember that investing is a journey. It's not, a get-rich-quick scheme. There will be ups and downs. But by following these principles, you can handle those bumps a lot better and stay on track to reach your goals.
This has been a fantastic deep dive. I feel like we've gone from, being kind of intimidated by investing to actually feeling ready to, take control of our financial futures. Thanks for sharing your expertise with us today.
Happy to do it. And remember, the most important investment you can make is in your own education. Keep learning. Keep asking questions. Be curious.
That's great advice. And to our listeners, thank you so much for joining us on this deep dive into the world of stock investing. Hopefully you've learned something new and feel inspired to start your own investing journey. Until next time, happy investing.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.